Hello financial fans, welcome back to another stock analysis. Today we'll be covering Unilever stock ticker UL. Unilever is a British-Dutch multinational consumer goods company that produces a wide range of products in various categories including food and beverages, cleaning agents, personal care and beauty products. The company's products are sold in over 190 countries and include popular brands such as Axe, Dove, Hellmann's, Knorr, Lipton and many others. Unilever is organized into three main business segments: foods and refreshment, home care, and beauty and personal care. The foods and refreshment segment produces and sells packaged foods, ice cream, and beverages. This includes products like soups, sauces, dressings, spreads, ice cream, tea, and coffee. The home care segment produces and sells cleaning products such as laundry detergents, fabric softeners, and household cleaners, as well as air fresheners and insecticides. The beauty and personal care segment produces and sells skincare, hair care, oral care, deodorants, and other personal hygiene products. In addition to its commercial activities, Unilever is also committed to sustainability and social responsibility and has set a number of ambitious targets to reduce the environmental impact and improve the livelihoods of people around the world. They are currently sitting at a $126.5 billion market cap, and in 2022 they generated a revenue of $63.1 billion. The dividend yield is currently sitting at 3.66%. 42% of their revenue comes from beauty and personal care, 38% from food and refreshments, and the remaining 20% from home care. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company. I will be using a standard margin of safety of 25%. That can never be below 0%. The margin of safety can either increase or decrease by the ratios that we're going to look at in just a moment. And the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in a scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction rather. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction. The first two metrics that we'll be looking at are the EBIT growth and the margin growth. The EBIT has gone up over the years, from almost $7.4 billion in 2013 to $9.7 billion in 2022. The average EBIT growth was 3.4%, meaning no change in the margin of safety. The margin has also gone up, going from 14.8% in 2013 to 16.19% in 2022. The average margin growth was 1.5%, meaning a 5% deduction in the margin of safety. The next two metrics are the dividend growth and payout ratio. The dividends have gone up over the years, going from $1.48 a share in 2013 to $1.80 a share in 2022. The average dividend growth during this period was 2.6%, meaning a 5% increase in the margin of safety. This with a payout ratio that's currently sitting at 58.2%, which is no change in the margin of safety on this metric. The final two ratios that we'll be looking at are the debt to EBITDA and the return on invested capital. To get a debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debts. And for Unilever, this is just over 2 years, in this case a 205% debt to EBITDA ratio, which is no change in the margin of safety in this metric. And our return on invested capital for Unilever is sitting at 11%, meaning no change in the margin of safety once again. Let's go look at the valuation models next to determine the intrinsic value of Unilever. The first valuation model we'll be using is the discounted cash flow model. I've imported the free cash flow of Unilever going from 2014 to 2022. The average growth and free cash flow annually during this period was 6.24%, and I'm projecting expected growth rate in their free cash flow of 4% annually over the next 10 years. And with this percentage, we'll be determining the future free cash flow for Unilever and determine a terminal year of valuation using a perpetual growth rate of 3% and a discount rate of 8%. This gives us a sum of free cash flow of $117.4 billion. And to get our equity value, we have to add the cash and equivalents and subtract the debt, leaving us with an equity value of $94.8 billion. All we have to do then to get our intrinsic value of this model is divide it by the amount of shares outstanding, giving us a discounted cash flow price per share of $37.48, which is a 25.4% downside out of this model. The second model we'll be using is the dividend discount model. I've imported the dividend payouts of Unilever going from 4 years ago to the current year. The average growth rate in their dividends during this period was actually minus 0.29%, but I'm projecting an expected growth rate in all of their future dividends of around 3%. and we'll be using a discount rate of 8% in this valuation once again. This gives us a dividend discount model price per share of $37.08, which is a 26.19% downside out of this model. The third model that we use is the Graham's valuation formula. In this model, we take a look at the earnings per share that Unilever is generating, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds in relation to the average yield of AAA corporate bonds, always sitting at 4.4. We go by the theory that a company with no growth always is sitting at a PE of 7. And looking at all of these metrics, we get a fair value of this model of $42.45, which is a 15.5% downside out of this model. The fourth model that we use is the multiple valuation. In this model, we take a look at similar companies as the Unilever, take a look at their stock price and their earnings per share. This way, we can determine the average PE multiple in the industry, which in this case is 28.26. All we have to do to get a fair value of this model is to then multiply by the earnings per share that Unilever is generating, which is $3.17 a share, giving us a fair value of $89.59, which is 78.32% upside out of this model. And the last model that we use is the mean reversion theory. In this model, we go by the theory that a company will always trade above or below its mean, and the metrics that we use to determine this are the dividend yield and the PE ratio. The dividend yield of the past 5 years has been sitting on average at 3.38%, while the current yield is sitting at 3.6%, indicating that it's currently undervalued on this metric. Doing the same for the PE ratio, the average PE ratio of the past 5 years has been sitting at 19.22. And the current PE ratio is sitting at 15.85, indicating that it's once again undervalued on this metric as well. This gives us a fair value of $57.22, which is a 13.89% upside out of this model. If you want access to all of the models that I use in my videos and way more, you can check the description for my Patreon link. Anyways, getting the self-promotion out of the way, let's go look at the final overview of a valuation next. Looking at our final overview, we've imported the discounted cash flow, discounted dividend, Graham's valuation, the multiple valuation, and the mean reversion theory price per share, giving us an average of $52.76. Without a margin of safety, we get an upside of 5% out of our models, but we have determined our margin of safety earlier, using a standard margin of safety of 25%, deducting by 5% for the margin growth, and adding 5% for the dividend growth. And applying this margin of safety of 25% then, we get a fair value of $39.57, and with the current price of $50.24, we get a downside of 21.23%, indicating that it's currently a sell. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments, and thanks for watching.